There's this fascinating paradox in the modern equity markets, right? The absolutely most lucrative opportunities are rarely the loudest ones. While mainstream financial media is just fixating endlessly on heavily covered momentum stocks and super crowded trades, the truly incredible asymmetric upside is usually hiding quietly right under the radar. So today in this explainer, we're going to unpack the exact mechanics of uncovering these hidden equities. We're talking about identifying profound market dislocations way before the broader consensus ever catches on. Okay, let's dive into this. What if the absolute best opportunities aren't actually trending on your feed? I mean, think about it. By the time a stock completely dominates the financial news cycle and retail sentiment, that premium is usually already baked right into the price. Instead of just chasing momentum and paying top dollar because of FOMO, the real alpha is found by identifying structural mispricing in the quiet corners of the market. It takes contrarian thinking, and you really have to be willing to look where the crowd simply isn't looking. Section 1. Beyond the stock hype. When we talk about an undervalued stock, we're not just looking for something cheap. Think of it like finding an incredibly high-quality product on a massive clearance sale. We're looking for a quantifiable, mathematical disconnect between what the company is intrinsically worth and what the market is currently pricing it at. Smart capital aggressively hunts for this specific spread. The actual business hasn't gotten worse. The market has just temporarily mispriced its future cash flows. Identifying and exploiting that specific gap is your foundational mechanism for generating really outsized long-term returns. Now, what's really interesting about this slide is the critical distinction it makes, which is going to save you from falling into classic value traps. There is a huge fundamental difference between a practically cheap stock and a genuinely undervalued equity. Let's be real, a $5 stock for a deteriorating, structurally weak business is not a deal. It's irrelevant. What actually matters is the multiple you're paying relative to the underlying strength of the business. Cheap does not automatically mean undervalued. A lot of times it just means impaired capital and a failing business model. To filter those traps out, we need a really solid objective framework. Section 2. Analyzing business fundamentals. So, this analysis requires a rigorous, interconnected four-step framework. First, you absolutely have to verify robust profits. But here's the catch. That profit is literally meaningless if it's getting swallowed up by massive debt. Plus, even if the balance sheet is completely pristine, the company still needs a distinct economic mode, a real competitive advantage, all steered by a management team intensely focused on disciplined capital allocation. These four pillars don't just stand alone, they constantly support each other to create a resilient business that can actually weather macroeconomic storms. Let's stress test that first pillar. Ask yourself, is this company generating actual, consistent free cash flow? We've got to look way past clever accounting tricks or adjusted EBITDA and really zero in on the tangible cash coming in from their core operations. Top-line revenue growth is basically a mirage if operating margins keep over time because they lack pricing power. Smart investing demands definitive proof of healthy, expanding cash flow and high returns on invested capital way before you ever purchase a single share. The next filter forces us to get strict about the capital structure. Can this business actually handle its debt load? We aren't just glancing at total liabilities here. We need to dynamically examine things like interest coverage ratios and debt maturity profiles. In environments where interest rates are high, over-leveraged companies face literal existential threats when they're forced to refinance. What might temporarily look like a super attractive valuation can rapidly turn into a bankruptcy if that balance sheet is fragile. The best businesses use debt strategically as a tool, definitely not as a desperate lifeline. Section 3. Exploiting market overreactions. So the crucial point is that emotional markets create discounted opportunities. Look, the market isn't always perfectly efficient. We regularly see these massive, totally irrational dislocations between the underlying reality of a business and aggregate market sentiment. This happens all the time because of automated algorithmic selling, abrupt institutional rebalancing, or just scary headlines that completely spook investors. When a structurally sound, highly profitable company takes a temporary hit just because of a broad macro panic, that specific overreaction is exactly where those highly favorable asymmetric risk-to-reward ratios are born. And honestly, you'll frequently find these deeply mispriced assets in the driest, most unglamorous sectors you can imagine. Nobody's going viral on social media for their hot take on regional waste management or industrial pipe manufacturing or steady local infrastructure, right? But that absolute lack of hype is exactly why you aren't paying a massive glamour premium. Unsexy industries often yield exceptionally beautiful, highly predictable free cash flow. Since the fast money retail crowd totally ignores them, they remain chronically mispriced, which gives us an incredible margin of safety. Section 4. Avoiding beginner traps. This ultimately boils down to a stark contrast between jumping into crowded trades versus practicing contrarian patience. When you follow the hype, you're entering a highly crowded space. If everyone is already universally bullish and retail investors are fully engaged, well, perfection is already priced in, and that completely ruins your risk-to-reward ratio. True contrarian patience means actively analyzing quiet, hidden value. You have to be willing to hold your conviction even when the trade feels incredibly lonely, just trusting that the underlying business fundamentals will inevitably close that valuation gap over a multi-year horizon. Let's move to and see how this builds into Section 5, Thinking Like an Owner. When we pull all this together, synthesizing healthy leverage ratios, robust free cash flow, definitive economic moats, and an intrinsic discount driven by temporary market fear, we get a definitive, repeatable framework for deploying our capital. This comprehensive setup elevates your entire strategy. We stop blindly renting stock symbols based on short-term chart patterns, and we start systematically acquiring equity in incredibly resilient, high-quality businesses. This kind of rigorous discipline is exactly what separates speculative trading from true generational wealth generation. So before you deploy any capital, you've got to ask yourself one defining ultimate question. If the market closed for 10 years and you literally couldn't sell a single share, would you feel perfectly confident holding this business? That profound shift in perspective, moving from being a short-term renter to a long-term owner, is exactly where the real wealth is built. Thanks for diving into this explainer with us today, and happy researching!